The US is paying $1 trillion a year in interest on its debt, not paying the debt down, just keeping it alive, and that's rising. The White House wants the Fed to cut short-term rates, hard. The new Fed chair, Kevin Warsh, knows he has to deliver. But cutting short-term rates can reignite inflation, and when inflation rises, investors demand higher long-term yields to fund the government. That's when the debt spiral starts. The current Fed solved this by buying long-term bonds, absorbing supply, keeping rates capped. The new Fed chair, starting in May, called that a disaster. So the new Fed chair has to cut rates without letting inflation push long-term rates higher and without the Fed printing money to buy bonds. That sounds impossible, but he has a plan, and you're not going to like it. Before the plan, here's the trap. There are only 4 exits, and 3 of them are either impossible or catastrophic. The last one is just very unpleasant. The US debt-to-GDP ratio is sitting at over 120%. That means the government owes more than the entire economy produces in a year. The last time it was this high was right after World War II, and what the government did to solve it back then is the same playbook being dusted off right now. Option 1 is running a surplus. Cut spending, stop borrowing, pay the debt down. Not happening. Option 2 is default. Just refuse to pay. The debt disappears overnight. So does the global financial system. Not realistic. Option 3 is growing the economy faster than the debt grows. This is the hope. AI, automation, productivity revolutions. Possible, but hope is not a strategy. That leaves option 4. Inflate the debt away. Let me explain exactly what that means, because this is where the new Fed chair's plan lives, with a twist. And you'll want to stay for the twist. Think about buying a house with a $500,000 mortgage. On day 1, your debt is 100% of the home's value. Now inflation rises to 4%. Dollars get weaker. You still owe $500,000 plus interest, but you're paying it back with dollars that are worth less than the ones you borrowed. And your house? Inflation pushes it to $520,000. Now that $500,000 debt is about 96% of what you own. So the burden feels smaller, not because you paid it off, but because the measuring stick changed. The government does the same thing, except the house is the entire US economy or GDP. The national debt is measured in dollars, but inflation makes those dollars worth less, while it pushes GDP higher in dollar terms. So the debt-to-GDP ratio shrinks. The burden eases, not because the debt disappeared, but because every dollar is worth a little less. But there's no free lunch. The government is deleveraging through inflation, and you're paying through higher prices, groceries, rent, everything. A quiet bill every day. Now here's where history gets uncomfortably relevant. After World War II, the US debt-to-GDP ratio was around 120%, very close to today. The government had the same problem. Too much debt. Can't tax enough to cover it. Can't let long-term rates rise because the interest costs would be crushing. But from 1942 through 1951, the Federal Reserve and the Treasury worked together. The Fed pegged short-term rates near zero and capped long-term yields at 2.5%. If inflation caused the bond market to push rates higher, the Fed printed money and bought bonds as needed until rates came back down. Whatever it took. It's called yield curve control. It's what they do when the debt gets too big. And it worked. The government borrowed cheaply to finance the war and the early post-war years. And that, along with an increase in post-World War II productivity, allowed the debt burden to shrink relative to the economy. But inflation also hit 17% in 1946. By 1951, it was over 20%. The Fed finally said, enough. They broke from Treasury control and regained their independence. That agreement, the Fed reasserting its right to set monetary policy without Treasury direction, was called the Treasury-Fed Accord of 1951. Here's what almost nobody gets about that history. The 1951 Accord wasn't the Fed agreeing to help the government. It was the Fed escaping the government. It was the Fed saying, we will no longer take orders on what bonds to buy and at what price. Now the new Fed chair is calling for a new accord. Same name, different outcome. Quick pause. If you're looking for stock picks, Seeking Alpha has significantly outperformed the S&P since 2022. There's a link for 10% off in the description. Now back to the new accord. What Warsh is signaling isn't independence from the Treasury. It's coordination with the Treasury, a framework where the Fed's balance sheet activities are aligned with the government's debt plans, where the Treasury has meaningful input into how the Fed manages its portfolio. That's not a return to 1951 principles. That's a return to what 1951 was supposed to end. And we know this coordination will involve lower rates, which can cause inflation, which can push up long-term borrowing costs. But the new Fed chair doesn't want the Fed to print money and buy long-term bonds to keep the government's borrowing costs low. So, when inflation hits, what's his plan? Two mechanisms. The first is technical, but the second is the one you need to watch. It changes who pays. The first is a rebalancing of the Fed's own portfolio. Right now, the Fed holds large amounts of mortgage-backed securities and long-term bonds. The Fed could sell those and replace them with short-term Treasury bills. That restructuring alone gives the government a fresh source of demand for its short-term debt without expanding the balance sheet. It's subtle, it doesn't look like money printing, but it has the same effect on the government's borrowing costs. The second mechanism is bank deregulation. This one is hiding in plain sight. Now stay with me. There's a rule called the Supplementary Leverage Ratio, the SLR. It caps how many US Treasury bonds a bank can hold relative to its capital. The rule exists to prevent banks from loading up on government debt to dangerous levels. In 2020, that rule was temporarily suspended. What happened? Banks went on a Treasury buying spree. Demand surged. Long-term yields fell. The government borrowed cheaply, but the suspension ended in 2021. Now imagine making that suspension permanent. If the SLR is lifted, banks can buy as much government debt as they want. The Fed doesn't have to buy long-term bonds. The new Fed chair gets to say he never engaged in the kind of quantitative easing he criticized for years. But the effect is similar. Long-term yields get capped because there's a massive new buyer absorbing every dollar of supply. And money that's been sitting on the sidelines floods the economy. The buyer is just the banking system instead of the Fed, and the banking system is sitting on your deposits. This requires coordination. The SLR is a regulatory mechanism that sits between the Fed and the Treasury. Lifting it needs both Scott Bessent and Kevin Warsh aligned on the same outcome. That alignment, that coordination, is exactly what the new accord provides the framework for. So here's what this actually means for you. They reduce the debt burden by making your dollars less valuable. Not with a new tax, with prices. The Fed cuts rates. Short-term borrowing gets cheaper. Inflation starts to build. Long-term bond investors push yields up. But banks, now freed from the SLR, absorb that supply and keep rates from spiraling. Inflation rises. The government borrows at rates below the inflation rate. The debt burden slowly shrinks in real terms. The debt-to-GDP ratio falls. Success for them. Watch what happens over the next 12 months. And you pay through purchasing power erosion. Every dollar you saved, every paycheck you earned, every fixed income investment you hold, it all buys less. Quietly, gradually. In a way that never shows up as a tax. In a way that never requires a vote. This is called financial repression. It's not new, it's the oldest trick in the government debt playbook. And it worked last time. After World War II, the debt-to-GDP ratio fell from around 120% to around 30% over the next 3 decades. The government deleveraged successfully. The people who held cash and bonds during that period saw their purchasing power quietly destroyed. The people who held real assets, land, commodities, equities with pricing power, saw those assets rise with inflation. History doesn't repeat, but it does follow the same math. The new Fed chair isn't writing in to save your savings. He's been handed an impossible equation and he found a solution. It's just not one where you come out ahead by doing nothing. The question worth asking right now isn't whether this plan works. It probably will, on paper, for the government. The question is what you're holding while it plays out. If this changed how you think about what the Fed is actually doing and why, hit subscribe. We publish fresh content several times a week to help you protect and grow your wealth. And none of this is personal financial advice. This is education so you can build your own plan. Next, watch, is the US planning a $37 trillion crypto debt reset? If you thought this plan was wild, that one will blow your mind. It's on the screen. In the description, you'll find links for 10% off alpha picks. You'll also see a link to my Wealth Builders Blueprint, a list of resources that can help you grow your wealth. I also included a link to Zacks Confidential, a stock recommendation service with dual money-back guarantees. Check them out. Thanks for watching. See you on the next one.